Welcome to Supernatural Stocks on Moneyweb with your host, the Finance Ghost. This is your weekly fix of equity analysis designed for stock pickers. Whether local or international, you can expect a mix of news and my ideas about what I'm seeing in the markets. This week, the news broke that Sun International and the shareholders of Piermont have mutually agreed to terminate the 7.2 billion rand deal that would have seen Sun International acquire Piermont's business that has 8 casinos in South Africa. The casino they really wanted, of course, was Emperor's Palace, with the rest of the portfolio being rats and mice. The Competition Commission took 172 business days, not calendar days, that's business days, to reach their recommendation in late 2024 that the deal should be prohibited by the Competition Tribunal. Then the Competition Tribunal itself took so long to set a date for the hearing and the closing arguments that it would have pushed the deal beyond the upcoming long-stop date. Hence, the parties would have had to agree to extend the long-stop date in order for the deal to stay alive. The long-stop date is the date upon which a deal lapses if all conditions haven't been met. If you've been following Remgro and Vodacom's attempts to get a fibre deal done, then that is a great example of the parties choosing to extend the long-stop date to try and keep a deal going. I cannot imagine that Piermont wasn't keen to continue with the transaction though, so I strongly suspect that Sun International used these regulatory delays as an opportunity to just wriggle their way out of the deal. They probably don't even need to pay the break fee of 75 million rand because the tribunal's date for the hearing is clearly outside of their control. Now, the parties certainly anticipated having a tough time with the regulator because this merger would have reduced the number of national casino operators in Gauteng from 3 down to 2. It would have led to 92% of the casinos in South Africa being owned by just 2 firms. Furthermore, a new entrant in the Gauteng market is unlikely because there are no unallocated casino licenses. So the shock here wasn't that the competition authorities didn't like the deal, but I do think the parties expected a much quicker process to at least reach a final decision. Generally speaking, the Competition Commission has unfortunately been doing a fabulous job in recent years of spooking international investors and anyone trying to do meaningful local deals. Not only does the regulator take forever to reach a decision, but then they often use the deal as a good excuse to insert onerous BEE requirements under the guise of public interest considerations. But that's a story for another day. Mergers and acquisitions have a patchy track record when it comes to shareholder value creation, so it's not unusual to see the market celebrate the death of a deal. Still, it sends a strong message that the Sun International share price is up by more than 12% in the past week. But why does the market feel that way? Why were they so happy to see this thing go? On the 5th of February 2024, Sun International released the deal circular for the acquisition of Piermont. It was an M&A classic, filled with a bullish rationale for the deal and the logos of leading advisors in the market. Having emerged from the pandemic with no small thanks to a 1.2 billion rand rights issue and 500 million rand in cost savings initiatives, Sun International was ready to get out there and do deals. They were done with staying home and staying safe, and so were their customers, or so they thought. In case you haven't noticed, sports betting has become a huge thing in South Africa. Many gamblers are getting their fix by using platforms like Hollywood Bets from the comfort of their couch, rather than getting in their cars and driving to the casinos like in the good old days. This trend was already there at the time of the circular, but I think the past 18 months or so delivered a massive negative surprise for the owners of traditional casino assets. Disruption has a nasty habit of happening far more quickly than people usually give it credit for. Here's the wording from that early 2024 circular dealing with casinos versus online gaming, and I quote, "Land-based casinos, while mature, will continue to deliver approximately inflationary growth in gaming revenues with strong margins and cash flow, while online gaming has significant potential for double-digit growth over the medium term." Well, they were half right at least. As a chart from a recent Sun International presentation in May 2025 tells us, online betting has become a far greater component of annual gross gaming revenue, or GGR, in South Africa than ever before. If you can't see the chart if you're listening to this on the road or wherever you may be, then the key point here is that in 2010, casinos were getting around 82.5% of GGR and online was getting just 11.3%. I remember those days where trips to the casino were a fun way to go and play a bit of poker with friends. Today, casinos are getting just 23.8% of GGR. That was in 2024. I'm sure it's even worse in 2025. And the last couple of times I've walked through a gaming floor at a major casino have been depressing, to say the least. Those same groups of friends are in all likelihood just betting online now, with betting enjoying a 68.1% share of GGR in 2024. LPMs and bingo have been surprisingly consistent over that period of roughly 15 years, suggesting a different kind of consumer behavior in that segment of the market. So whilst Sun International was correct that online gaming has significant potential, they were very wrong about inflationary growth in gaming revenues at land-based casinos. The truth of it is that casinos have flatlined. The same presentation shows us that from 2023 to 2024, Sun International's Sunbet business increased its contribution to adjusted EBITDA for the group from 6% to 10%. Over the same period, urban casinos fell from 65% to 60%. And what of mentions of Piermont in that May 2025 presentation? Well, a search of the document reveals just a handful of references, mainly related to adding scale through the transaction, and talking about trying to maintain the dividend payout ratio post the deal. That's hardly exciting. And yet, we are talking about a deal that was expected to increase Sun International's group debt from 5.9 billion rand to 13.2 billion rand based on the numbers in that circular. As things transpired, by the end of 2024, they had gotten their debt down to 5.2 billion rand, but they would still have been putting 7.2 billion rand in additional debt on the balance sheet. This would have been needed to facilitate the payment of 3.2 billion rand to the sellers of Piermont and 4 billion rand to refinance the existing debt in Piermont. That is a lot of risk for a transaction that had run out of reasons for existence beyond just scaling the group. And scale for the sake of scale is a very bad reason for a deal. Also, the pricing of the deal was starting to look extremely spicy based on current market trends, with Sun International having agreed to pay an EV/EBITDA multiple of around 5.8x for Piermont. Even after the latest rally in the share price, Sun International is trading on an EBITDA multiple of around 5 times. So I cannot see how Piermont could possibly achieve a price of 5.8 times in the current environment without it being thanks to a legacy agreement for that price. This is also why I'm so sure that it wasn't really a mutual decision to kill the deal. I think it was Sun International's decision, and Piermont just had to go along with it because what choice do they really have? So what does the future hold? Sun International has a brand new CEO. Ulrich Bengtson has tons of global experience in the gaming industry, and his comments thus far have focused on Sun International's growth opportunities in an omni-channel landscape. But they are already an omni-channel business, and it's hard to see how buying more land-based casinos would really add to that story, even if competition regulators were happy to let them do it. So I personally doubt that we will see acquisitions in South Africa of such casinos. This leaves Piermont in a difficult situation. It's a really hard asset to dispose of now, unless they take a serious bath on the price and a private equity player picks it up for an EV/EBITDA multiple of somewhere around 4 times, or more like 3 times, then pumping it full of debt and hoping to emerge after 7 years with a debt-free business that has made them a fortune, even if it shrunk its profits along the way. Private equity deal dynamics are fascinating. But nobody is more disappointed than the advisors. Having come from an investment banking background, I always look at the fees on deals. Corporate advisors tend to operate primarily on success fees, which means a dead deal is a big financial disappointment. Nedbank was set to make 33 million rand from Sun International, and RMB was en route to make 23 million rand from Piermont. I'm sure some of those fees were linked to earlier milestones in the deal, but there's no doubt in my mind that money has been left on the table here. This is where sending regular bills is so valuable in advisory services, something that attorneys have mastered. Bowman Gilfillan, perfect example. Their legal fees from Piermont were set to be 17.5 million rand, not far off RMB's corporate advisory fee, might I add. CDH and Weber Wenzel weren't exactly set to do badly on the Sun International side either, let me tell you. The total fees on the deal were expected to be 122 million rand, assuming there were no overruns. And given all the delays in the competition process, I would be surprised if that wasn't the case. The lawyers would have done just fine out of this despite the deal collapsing because of how their business model works. As for the corporate advisors, I suspect they will be licking their wounds. An incredibly different and highly ironic outcome versus a successful deal, say 2 decades ago, that would inevitably have ended in a trip to the casino to celebrate. Things change, and I think Sun International shareholders are only too happy to see this deal go. There's no such thing as an opportunity without risk, and these are merely my opinions on the stocks covered herein. Make sure that you do your own research and form your own views on the market when doing anything in your portfolio. Nothing in supernatural stocks should be taken as advice.